Hello and welcome. In this on-demand video, OJM Group partner Jason Odell discusses one option for physicians to access low-interest rate loans without incurring additional taxes. If you have more questions or want to learn how to incorporate this topic into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Welcome. Thanks for joining. Today we're going to discuss where you can access cash with interest rates below 1% and why you might want to do that. Let's say you've got an opportunity to make an investment into some type of surgery center or medical spa or some kind of a real estate startup, something like that you want to do. What if you're interested in buying a vacation home or putting a down payment on a vacation home, doing some sort of personal asset purchase of some type or expense that comes along, such as a tuition, or maybe even some unforeseen medical expense that you have, or you want to take that family vacation that includes the entire family. Well, we always say that, there's rule number one, right? Which is, do not incur any taxes to generate cash if you don't have to, right? We don't want to generate a tax bill if for some reason you need to access cash. So historically, people would tap into a lot of different vehicles, borrowing money from lenders because interest rates were lower. But if we look at where federal capital gains tax rates are now, and you add state tax rates and the ACA tax, could lose about 35% of whatever asset you're selling to make that purchase. So we never want to let taxes wag the dog's tail. But at the same time, if you can avoid paying taxes, why not do that? Lots of long-term assets have significant buildup in capital gains, because we've seen this huge run up in the market over the last 10, 15 years or so. So right now, the markets in 2022 were down. So in 21, we had some highs, 22, we've had some downs. And so now this year in 2023, we're looking like market is up, but is that going to remain the same? So again, the story behind this is if you don't have to pay taxes to generate cash that you need right now, why do it? Some articles over the recent years that just talk a little bit about what do the wealthiest Americans do in terms of how they're avoiding taxes. So, you can buy, borrow, and die. And how are wealthy Americans doing it? There's a number of different articles from Business Insider and the Wall Street Journal and CNBC that talk specifically about buy, borrow, and die, and how that works. So what's worked for 15 plus years is you borrowed at low interest rates, right? So for 15 years or so, we've had very low interest rates, and you were able to borrow money, whether it was on a home equity line of credit or some sort of a secured personal loan or margin loan or something of that nature. You're borrowing, you had rates below 3%. You had rates as low as 1.5% to 2% at one point in time. And what happened was in 2022, rates were low, but now in 2023, we've seen the Federal Reserve hike rates significantly. And now you're looking at borrowing rates at more than 6 to 7%. You can see the graph here for the mortgage, 30-year fixed mortgage rate, and what's gone on and how much it's gone up just in recent months and how significant it is. So accessing and tapping into cash on a borrow standpoint from your traditional ways of borrowing money is not working as efficiently as it was historically. So what does work? Where can we go get cash? Where can we access cash at extremely low interest rates, even below 1%? Well, there is one vehicle that a lot of our clients have utilized in the past and are continuing to fund, which is cash value life insurance. Cash value life insurance, or permanent life insurance, has a value as you pay in your premium to it. It builds a cash value to it, and that cash value has significant benefits. Number one is after tax premiums are contributed to the policy, but once in the policy, grow tax-free and can be accessed via withdrawals and loans on a tax-free basis. And when accessing that cash value, you can access it tax-free with specific contracts that have low interest rates, typically below 1%. And those are contractually guaranteed interest rates that they'd be charging you at below 1%. You can pay back the loans if you want to, when you want to, not at all. And what ends up happening is, as if something were to happen prematurely or at your death and you didn't pay back the loan, it just is a reduction in the death benefit going out to your beneficiaries. What's crucial about cash value life insurance is making the proper policy selection, making sure the policy is structured properly, making sure you have access to the cash value in an efficient way. The significant benefits, as I mentioned, the tax-free buildup of that cash value and the tax-free withdrawals and loans is important to understand how it works and making sure you're working with a firm that understands the ins and outs of these policies, the expenses associated with these types of contracts, because there is a cost for the death benefit. So you want to make sure that when the policy is designed, it's designed as efficiently as possible to have that cash value grow. In addition, in about 23 states, cash value life insurance is exempt from creditors. So it's a great asset protection tool to utilize and have in place. In addition, if you currently have some type of a permanent life insurance policy, whether that's a whole life policy, a variable life policy, a universal life or indexed universal life policy, you can actually use that policy and do a tax-free 1035 exchange if that's a poor performing policy into a better performing policy that may have low borrowing rates available to you. So you'd want to have those policies, if you have any of them in place currently, reviewed to see if they performing efficiently. Are they efficient for accessing the cash value, or are there alternatives out there that may be better off for you? So if we look at a case study using life insurance to avoid taxes and to pay off some sort of high interest loan that you currently have, one of the things that we're looking at here is, if you had a renovation, a physician client of ours had a renovation to their kitchen in 2021. And so they drew down on their home equity line by about $200,000. The original home equity line of credit interest rate was less than 3.5%. It remained that way all the way through Q1 of 2022. But in Q1 of 2023, interest rates went all the way up to 7%. So now that home equity line was significantly more expensive. This physician happened to have two cash value life insurance policies that were in place. The largest cash value in a policy goes all the way back to one that was put in place in 2000 with a contractual interest rate in the contract of 0.25%. And currently that insurance company is crediting that 0.25% on any loaned funds that are borrowed out of the policy. So it equals a wash loan. So what does that mean? That means they're borrowing money out of the policy of the cash value that they have in their policy, the $200,000 out. They're repaying off or paying off that home equity line that's at 7% right now. And it's a wash loan to them. It doesn't cost them any money to do it. And if they had the intention of paying off the home equity line, which they did, they can now just deviate those payments that were going to the home equity line to going back into their insurance policy at a 0% interest rate to them versus a 7% interest rate. And therefore replenishing the loan, the $200,000 that they pulled out of the policy over time, or as I mentioned earlier, not even at all if they never wanted to, or extending it over a very long period of time, or they could put the money back in the future. If something happens, some sort of sale of something happens, they could put the money back into the policy. But being your own bank and using policies like this is a great way for a long-term tax and interest reduction strategy. This is a good tool to use. Again, you may have some policies that you currently have already or have owned for a period of time. Having those reviewed to see if they're efficient is important. In addition to that, making sure if you're interested in this kind of a strategy, it's designed properly. There are policies where you can make lump sum contributions into them, significant lump sum contributions, let that grow in a tax-free environment and have access to that over a period of time to pull money out tax efficiently if you wanted to for retirement. but also for just paying off anything that you would want to do that has a higher interest rate, or potential if you were trying to borrow something or borrow money to make an investment. This is a good tool. So this strategy works for good long-term tax and interest reduction.
OJM is a multidisciplinary wealth management firm. For nearly 2 decades, our firm has helped physicians across the U.S. reduce taxes, protect assets, and achieve their financial goals. OJM Group offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. We hope to speak with you soon. Thanks for watching.